Hello everybody, here from Chicago. We have our February 2015 market update for you. Well, you know, the Fed stopped the bond buying program and the world didn't blow up back in October. GDP was up 5% in the third quarter, 2.6 in the fourth quarter, so the economy overall did about 2.4 last year. It was 2.2 the year before. So this slow growth pattern is continuing. You know, we have internationally, we got Putin to deal with, we've got ISIS to deal with. You know, North Korea is always an issue. There's issues with very slow or negative growth in the international community, which we're watching. Inflation's been benign, still under 2%. And we've had the budget deficit now, believe it or not, is down to under $500 billion, which is under 3% of gross domestic product. That's something we haven't seen in a long time. So there's some positive stuff out there. But you know, there's a gentleman named Sir John Templeton, and one of the things he's been famous for saying is, you know, bull markets are born on pessimism, and then they grow on skepticism, and then they mature in optimism, and then they die in euphoria. So Kevin, I think we're somewhere around maybe, you know, skepticism and optimism, but, you know, what do you think's going on right now?
Well, we've talked about in previous market updates that this rally here is a little bit different than previous ones. I mean, 2008 is still so fresh in people's minds, and in a lot of ways this market has been underowned and fueled a lot by maybe the money that the government's been putting into the system, which is what makes a lot of people wary. So the euphoric levels that we've had have never really been there. This has been you know, a market rally of angst as much as it's been from optimism, I think. That's probably one of the only indicators that gives me some degree of comfort that you know, you're not subject to a big decline from here, because the market is underowned in a lot of areas.
Right.
Now, whether this is sustainable going forward in terms of corporate earnings, you know, we've had low growth environments before. You know, earlier in 1980, 1990, you know, 2.5% gross domestic product growth is not, you know, it's still what they say maybe the minimum to keep things going along positively. But so what's the old cycle is that the market goes up from companies making profits, and it goes up faster sometimes and goes down because of fear and greed and human emotion along the way. Are we at a period of extreme overvaluation? I don't think. I mean, if you look at traditional values of measures, the market's fairly valued, maybe slightly overvalued, more overvalued if you look at more conservative indicators like we talked about last time, the Cape-Shiller, which looks at longer-term earnings and normalizes over average. But then again, markets can stay in periods of time where they're overvalued for extended periods of time as well as undervalued. They never can stay at fair value. But inflation being low, the market, you know, last year we were looking for interest rates to go up, and actually the 10-year Treasury is lower. So, you know, some people would say you have still the possibility of deflation and recession there. Which again, of course, makes the market go down, right? But then again, that's what markets do. But hopefully, you know, obviously you got to get back to your time frames and your individual situations in terms of, you know, calibrating your risk levels.
Yeah, the other thing that we have seen out there, and everybody's aware of this, you know, you go to the pump and it's costing you $1.50 less for gas, and so the energy patch, couple good and bad, good for the consumer, supposedly $60 a month more coming back in their pocket, but what they're doing is they're paying down debt, they're saving, and now we just saw recent charts that say consumer discretionary spending is going up. So we still don't know what's going to happen there. The energy folks tell us that, you know, these various basins that have fracking, we won't really see anything from that for another 3-4 months. But it's hard to say how that's going to have an effect. Everybody's got different sides of that equation. But the other part that's interesting that's been going on in the last 2 months, Kevin, you and I have talked about is, you know, down 4%, up 5%, down 4%. It's like this. We've had 6 cycles in a very short period of time. And some people say this is a stock picker's market.
Well, you look at last year, and it was a tale of kind of a first half and a second half, and the first half was pretty much broadly up, and the second half you had some areas up and then other areas down. International emerging markets, high yield bonds. A lot of this which was happening in the second part of the year were concerns about energy and Europe, causing some areas to decline more in value. So there's obviously a lot more uncertainty where these questions are all being asked. You know, interest rates, Europe and the euro, Greece, Ukraine, ISIS. Then again, but those types of questions have been around, as long as we've been in the business, right? It's just different circumstances, same types of indicators. So coming back full circle, the market's looking for traction. The Fed's signaling like crazy. We're going to be increasing rates. We're going to be increasing rates. So we hope we don't get like we did in May of 2013 when they started actually doing it, where you have a big decline in the bond market.
Right.
But in the meantime, while they've been saying that, the long rates have come down.
Yeah, absolutely. So to wrap up, we have looks like this continued slow growth. Corporate earnings have been coming in above what they expected. Like we're just thinking in a growing economy. Job growth, over 200,000 people per month for the past 12 months. That's good stuff that's happening out there. So we'll have to see.
So continuing to be cautiously optimistic, but having some reserve in if you want to err on the side of caution and taking advantage of opportunities as they might arise.
So Sir John Templeton might say we might be moving into some optimism.
Yeah, I look forward to that.
Yeah, that'd be great. So until next time, have a great quarter.
Thank you.